They absolutely dumped it right when the market opened, sending a shockwave through the charts that was designed to make you feel sick. If you looked at your screen this morning, you saw red candles stacking up like dominoes and weeks of hard-earned gains evaporating in a matter of hours. They want you to believe this is a natural sell-off, and they want you to believe the bull run is over, so you'll panic and hand over your position. But I need you to listen to me very carefully right now, because this is not a sell-off. This is a crime scene. What you're witnessing is not a market functioning by the laws of supply and demand. It is a market that has been broken on purpose by entities who are desperate to cover their tracks. While the price on your screen was crashing, something else was happening in the background that makes absolutely no sense if you only look at the surface. Usually, when the price drops this hard, it implies there is too much supply and nobody wants the product. But go try to buy a physical ounce of silver right now and see what happens. If you check the major dealers or the sovereign mints, you won't find panic sellers or bargain bins. You will find out-of-stock signs, 404 error pages, and premiums that are effectively double the spot price because the metal simply isn't there. How can the price be crashing on the charts if the physical shelves are completely empty? This contradiction is the smoking gun that proves we are no longer in a real market, but rather a paper simulation designed to shake you out of your generational wealth. Today I am going to show you exactly how they executed this raid and who was on the other side catching the falling knife. We are going to look at why dealers are dangerously close to defaulting on deliveries, and we will expose the story of the great silver disconnect that the mainstream financial media refuses to cover. Let's start by dissecting the mechanism of the crash, because you need to understand the weapon they used against you. Nobody loaded up a truck with physical bars and sold them at a discount today. That simply did not happen. What happened was a coordinated paper raid in the futures market where you don't need actual metal to sell silver, you just need a contract and massive leverage. In the middle of the night, when trading volume was thin and liquidity was low, they dumped billions of dollars in paper contracts to overwhelm the bid stack. This is like shouting fire in a crowded theater because the algorithms react first, seeing the price dip and selling instantly to protect their models. This triggers a cascade where leveraged traders get hit with margin calls, forcing them to sell regardless of their long-term conviction. When a margin call hits, the broker doesn't care that solar demand is going vertical or that China is hoarding every ounce they can find. The broker just liquidates the position. This creates a waterfall event where the price collapses on paper, but the physical reality remains completely unchanged. While the paper price was bleeding out on the COMEX in New York, the physical price in Shanghai barely moved, and the premiums in London held firm. The disconnect is now undeniable, creating a world where we have two prices for silver, the fake price on your screen and the real price that industry actually pays. This gap has become dangerous because it exposes the insolvency of the entire fractional reserve bullion banking system. Now, we need to talk about the mints, because their behavior during this crash is the most terrifying signal of all. Historically, when silver prices crash, mints slow down production because they anticipate that investor demand will dry up. But this week, we saw the exact opposite happen as mints stopped selling entirely, not because of a lack of buyers, but because they couldn't source the raw silver blanks to stamp the coins. The US Mint has been on allocation for months, which is a fancy way of saying they are rationing silver like it's a strategic resource during wartime. We now have confirmed reports of major sovereign mints canceling orders for wholesale dealers, telling them they simply cannot fulfill the contracts. If the price is truly crashing due to a lack of interest, there should be a glut of silver available for immediate delivery. But there is no glut because investors aren't dumping their physical metal. They are dumping their paper contracts while gripping their real assets tighter. Smart money sees this discount as a gift, and they are sweeping the market, creating a liquidity squeeze at the wholesale level that is choking the refiners. Refiners cannot get 1,000-ounce bars fast enough to melt down into retail products, and miners are holding back supply because they refuse to sell their labor at these manipulated prices. So the supply chain is snapping in real time. And when the supply chain snaps, the retail dealers get caught in the middle with liabilities they cannot meet. I'm getting emails from people who placed orders weeks ago, paid good money, and received a confirmation number, yet they still haven't received a shipping notification. When they call customer service and sit on hold for 2 hours, they are given excuses about shipping delays or system upgrades. These are code words for a much uglier truth. The dealer sold you silver they did not have, and now they can't find it at a price that keeps them solvent. We are seeing the early stages of a failure to deliver event that could ripple through the entire precious metals ecosystem. This is what happens when you treat a finite resource like an infinite financial derivative. Eventually, the math catches up with the fraud. You need to understand that the paper market is leveraged hundreds of times over, meaning for every ounce of real silver in the vault, there are hundreds of people holding a piece of paper that claims they own it. As long as everyone is happy trading paper back and forth, the game continues and the banks collect their fees. But the moment confidence breaks and people stand for delivery, The game of musical chairs ends, and there aren't enough chairs. We are seeing a run on the vault that is being disguised by these violent price smashes. The banks know that if silver breaks above $50 or $100, the FOMO from the retail public will be uncontrollable. So they have to smash the price down to break the psychological momentum, hoping you will get bored or scared and sell your position back to them. But this time, the tactic isn't working. Because the buyers aren't just retail speculators, they are sovereign nations and massive industrial conglomerates. Let's talk about the industrial consumption because this is the floor that prevents silver from ever going to zero. Solar panel technology has changed rapidly in the last 24 months, moving from PERC cells to TOPCon technology, which requires significantly more silver per unit. The solar industry alone is consuming hundreds of millions of ounces annually, and they are not price sensitive because silver is a tiny fraction of the total cost of a panel, but is absolutely essential for its function. If silver goes to $100, a solar manufacturer doesn't stop buying. They just pay the price because without silver, they have no product to sell. Then you have the military-industrial complex, which is ramping up production of missiles, satellites, and guidance systems that all require high-purity silver. Do you think Raytheon or Lockheed Martin cares about the paper price on the COMEX when they need to fulfill a government contract? They will pay whatever is necessary to secure the metal, and they are bypassing the exchanges to go directly to the miners. This creates a shadow market where the real physical deals are happening behind closed doors at prices far higher than what you see on TV. The COMEX is becoming a showroom for a product that isn't actually for sale, while the real inventory moves through private channels. We also have to address the elephant in the room, which is China and their aggressive accumulation of strategic commodities. While Western investors are being shaken out by volatility, China is importing silver at a record pace, draining the vaults of London and Switzerland. They understand that the US dollar is losing its global dominance, and they are trading their paper reserves for hard assets before the rest of the world catches on. This is a geopolitical maneuver designed to corner the market on the materials needed for the green energy transition and the next generation of electronics. By suppressing the price in the West, we are essentially subsidizing China's accumulation, allowing them to buy our strategic resources for pennies on the dollar. It is the greatest strategic blunder in modern economic history, and it is happening right in front of our eyes. If you're holding physical silver, you need to detach your emotions from the daily price swings, because they are designed to manipulate you. The volatility is the fee you pay for the potential returns. The only way to lose is to get scared out of your position. Think about why you bought silver in the first place. Was it to make a quick buck next week, or was it to protect yourself from the devaluation of the currency? The fundamentals that drove you to buy have not changed. In fact, they have only gotten stronger as the debt spirals out of control and the geopolitical situation deteriorates. The government is printing money at a rate that guarantees inflation, and the only way to protect your purchasing power is to hold assets they cannot print. Silver is the only asset that is currently cheaper than it was in 1980, despite the money supply increasing by exponential amounts. This makes it the most undervalued asset on the planet, a compressed spring that is being held down by the weight of paper manipulation. But the energy required to hold that spring down increases every day, and eventually the manipulators will run out of energy. When that happens, the snapback will be violent and it will be fast, likely happening overnight when the markets are closed. You will wake up one morning to find that silver is gapped up $10 or $20, and there will be no offer in the market. The dealers will be wiped clean, the mints will be closed, and the paper market will be locked limit up. Those who are waiting for a pullback to buy more will be left on the sidelines, holding worthless cash while the train leaves the station. This crash you are seeing today is likely the final shakeout, the last attempt to clear the leverage before the real move begins. History shows us that every major bull run in precious metals is preceded by a terrifying crash that tests the resolve of the true believers. In 2008, silver crashed 50% before rallying nearly 500% over the next 3 years. In 2020, silver crashed along with everything else during the pandemic panic, only to double in value a few months later. The pattern is always the same. First, they crash it to steal your shares, and then they pump it to sell it back to you at the top. Don't let them steal your position this time. Recognize the game for what it is and stand your ground. We are entering a period of resource nationalism where countries will stop exporting their raw materials to protect their own domestic industries. Mexico, Peru, and China are already making moves to nationalize their resources or restrict exports, which will further tighten the global supply. When the miners stop selling and the countries stop exporting, where will the COMEX get the metal to fulfill its contracts? They won't, and that is when they will declare a force majeure, settling contracts in cash instead of metal. This will be the moment the paper market officially dies, and the price of physical silver decouples completely. You will have a cash settlement price of maybe $30 or $40, but the street price for a physical ounce will be $100 or more. This bifurcated market is already starting to emerge, which is why we see such high premiums on physical products. The premium is the market telling you that the paper price is a lie and that the real value is much higher. Do not be fooled by the spot price. It is a tool of misdirection used by the banks to manage inflation expectations. If they allowed gold and silver to rise to their true value, it would signal to the world that the dollar has failed. So they must suppress the metals to maintain the illusion of fiat currency stability. But they are fighting a losing battle against mathematics. You cannot print silver, you cannot debase it, and you cannot create it out of thin air on a computer screen. It requires geology, exploration, labor, energy, and time to bring an ounce of silver to market. All of those costs are rising, putting a floor under the price that is much higher than what the charts suggest. So when you see the price crash, do not despair. Look at it as a validation that you are over the target. They only attack the things that threaten them, and silver is the greatest threat to the fiat currency system. By holding silver, you are betting against the debt, against the central banks, and against the sustainability of the current system. It is a bet that has never failed in 5,000 years of human history because every fiat currency eventually returns to its intrinsic value of zero. Silver has survived empires, wars, and collapses, and it will survive this current financial experiment as well. The banks are short, which means they are betting on the price going down, but they are trapped in their positions. They are desperately trying to cover their shorts without spiking the price, but the liquidity isn't there. Every time they smash the price, they dig themselves a deeper hole because physical demand increases. It is a trap of their own making, and eventually they will be forced to capitulate and cover at any price. This will trigger a short squeeze that will make the GameStop event look like child's play. We are talking about the global monetary metals, not a failing video game retailer. The short squeeze in silver will break the banking system and force a reset of the global financial order. You are holding the insurance policy for this event, so why would you sell it right before the payout? Stay strong, stay liquid, and do not let the red candles shake you out of your conviction. The wealth transfer is happening right now, moving from the impatient to the patient, and from the paper holders to the physical holders. Make sure you are on the right side of that transfer when the dust settles. Keep your eyes on the physical inventories, not the paper price, because that is where the truth lies. The vaults are draining, the mines are depleting, and the industrial demand is exploding. The math is inevitable and time is on our side. They can rig the charts, but they cannot rig the geology, and they cannot rig the laws of physics. Silver is essential, it is scarce, and it is currently on sale for anyone brave enough to buy the dip. This is the opportunity of a lifetime, disguised as a crisis. Do not miss it because you were looking at the wrong signals. The dump is the fake out, the scarcity is the reality. Hold the line.